Good afternoon and welcome to Unlock the Stock, everyone. We are pleased to welcome Harmony Gold to the platform today. And as you know, Unlock the Stock is specifically designed for investors to gain access to corporate management and to get to know them and their companies better. Unlock the Stock is only possible with our technology partner, Lumi Global. And you can visit their website, lumiglobal.com, to hear more about their various online AGM and investor presentation solutions. Our host, as always, will be the finance ghost and Mark Tobin from Coffee Microcaps, and they'll be facilitating the Q&A session today. This event is sponsored by A2X, a stock exchange that plays an integral part of the progression of South Africa's financial markets. A2X is the second largest stock exchange in Africa, as measured by market cap, with 176 securities listed on the platform currently, including 30 top 40 stocks with a combined market cap of some 10.7 trillion rand. The team at A2X are proud to be partnering with The team at A2X are proud to be partnering with Unlock the Stock. Just as this platform unlocks value through insights and analysis, so does A2X unlocks value for the stocks listed on its platform, helping to drive the market forward. We'd like to welcome today Beyers Nel, the CEO, and Jared Keyter, Head of Investor Relations of Harmony Gold, for the session. And just before we start, I have a few housekeeping notes to share with you. Beyers and Jared will take you through the presentation, followed by the Q&A. Please note that you'll be able to post questions by typing them into the Q&A box at the bottom of your screen. This event is being recorded as usual and will be available on the Unlock the Stock YouTube channel soon. And you'll also see an email address when we begin the Q&A. If you'd like to be added to Harmony Gold's distribution list, please just send an email to that address. And hopefully, without any more hiccups, I'm going to hand over to Beyers. If you could please share your screen and just take us through the presentation. Thanks so much, Beyers.
Thank you, Deborah. Good afternoon, everybody. My name is Beyers Nel. I'm the Group Chief Operating Officer of Harmony, and I'm joined this afternoon by our Investor Relations team. A big thank you to Keyter, Rech of Investor Solutions and the Unlock the Stock team for hosting Harmony today. It's a great pleasure to share Harmony's story with you. And for those who missed it, we released our full year results of the financial year ended 30 June 2023 on the 30th of August. I'd like you to please take note of our safe harbor statement. And let's start with our company strategy and an update on our excellent performance for the 2023 financial year. Our strategy is aimed at long-term value creation. We achieve this through the production of safe, profitable ounces and improving margins through operational excellence and value-accretive acquisitions. We at Harmony is a special gold producer with a growing international copper footprint. We have over 73 years of gold mining experience in South Africa and have been operating for almost 2 decades in Papua New Guinea. During this financial year, we added a Tier 1 mining jurisdiction with the acquisition of Eva Copper in Australia. At 1.47 million ounces, we are South Africa's largest gold producer by volume and have a diversified portfolio of operating assets which include gold, silver, and uranium. Our market cap at the moment is approximately 49 billion rand, and we have again been included in the JSE Top 40. We have 9 underground mines, 2 open pit mines, and various tailings retreatment operations. And we employ almost 46,000 valued employees at our operations. Our gold tailings retreatment business, or recycling as you may know it, is the largest globally and is set to grow further, supporting the circular economy. In addition to the various projects we have in South Africa, the Tier 1 Wafi-Golpu project in Papua New Guinea and Eva Copper in Australia provide us with a sizable international copper-gold footprint. Mining with purpose ensures all our stakeholders share in the benefits of the minerals we extract. And today, we will provide further insights into how we create long-term value for all. And with continued positive returns, we are directing major capital towards higher quality assets and projects. Our 4 strategic pillars support our planning and investment decisions in Harmony. These capital investments will drive down costs and improve margins, thereby transforming Harmony into a higher quality gold and copper producer. Our South African high-grade and optimized underground mines are delivering strong operational free cash flows to support our growth aspirations. Our high-margin South African retreatment operations in the Free State, West Wits area, and the Wafi-Golpu regions are low-risk and support our contribution to the circular economy. These operations all continue supporting our international copper-gold growth aspiration. As illustrated here, you can see each of our 4 quadrants formed based on production, operating free cash flow, and margin. Our South African high-grade underground operations have been the driver of our solid operating free cash flow due to their good margins. The South African high-grade operations contributed 31% towards group production and generated 3.5 billion rand in operating free cash flow at a margin of 23%. This represents 57% of group operating free cash flows. Our South African optimized underground portfolio contributed 42% to group production and 1.1 billion or 19% to group operating free cash flows. Our South African surface operations contributed 18% towards group production and generated 835 million in operating free cash flow. Margin at the South African surface operations remains suppressed, somewhat due to the large capital project underway at Mine Waste Solutions. Hidden Valley, or our international quadrant, contributed 9% towards total production. 600 million in operating free cash flows was generated at a 14% margin after very good fourth quarter results from our Hidden Valley mine. Harmony continues its exciting growth journey supported by a clear strategy to deliver on its objectives. Since we embarked on our growth strategy in early 2016, we have demonstrated our ability to create shared value through effective capital allocation and discipline. This is an ongoing and integrated process to find the optimal mix, ensuring we deliver on our strategy. And it is important that we invest now to deliver future growth and returns. Our capital allocation guidance is available in the annexure to this presentation. We have further prioritized capital to drive safety and production improvements. And in anticipation of Eva Copper and our other key projects, we have maintained a strong and healthy balance sheet and intend to keep our net debt to EBITDA below 1x. Through effective capital allocation, we have not only lowered our overall risk profile, we've also improved our margins and demonstrated our ability to generate meaningful returns, and also converted our resources to reserves, thereby expanding the production profile. Harmony, with 138 million ounces of mineral resources and 59 million ounces in mineral reserve, presents a substantial opportunity to invest in an exciting copper-gold story. Our international copper projects now represent 23% of our mineral resources through Eva Copper in Australia and Wafi-Golpu in Papua New Guinea. Our 2024 financial year declared mineral resources have increased by 4% year-on-year, with our mineral reserves having remained steady. There is therefore upside potential to our reserves once Eva Copper and Penang Central feasibility studies are complete. Now, what's worth noting is that with only around 26% of our reserves in South African underground mining, our production portfolio has been significantly de-risked, and the balance of future production will come from SA surface gold, PNG copper and gold, and later in time, Australian copper. We therefore offer counter-cyclical diversification through our lower risk and well-diversified gold and copper portfolio. Talking about growth, our quality growth pipeline will unlock further value as we take our projects up the value curve. We are conducting various exploration drilling activities across all our jurisdictions. These include regional drilling in Eva Copper, surrounding tenements, a pre-feasibility study, include the Keremengi heap leach project near Hidden Valley, and expanding our surface sources to convert the 5.7 million ounces in mineral resources to reserves. As we have communicated, the Eva Copper feasibility study are being updated. We expect to have the results in the third quarter of the 2024 financial year. We are also finalizing the feasibility study to determine whether we can extend Mponeng safely and profitably. Mponeng has 24 million ounces in mineral resources at an estimated in situ grade of as high as 13 grams a ton. This could potentially add 25 years to the life of mine of Mponeng. As part of our offshore portfolio, we have signed a non-binding framework MOU in April this year. And we have taken a significant step closer to obtaining the mine development contract for Wafi-Golpu. This is a prerequisite for granting of a special mining lease. There are also other projects in execution, and they include sizeable, which is the 9 gram a ton high-grade life of mine extension of the Mo-Kotsong mine, Rech, which extends the tailings surface facility at Mine Waste Solutions, adding 14 years life of mine, the Duracop extension of 207 and 212 levels, and the Hidden Valley extension with a stage 8 cutback currently underway. On our results for the financial year, we delivered a solid set of results for the financial year 2023. In fact, 2023 was a landmark year for Harmony. Not only did we again deliver against all guided metrics, but our expansion into near-term copper took hold. We have built up incredible momentum supported by an improved safety performance. Our group lost time injury frequency rate per million hours worked improved to 5.49. This has remained below 6 for 2 consecutive financial years now, a first in our 73-year history as a company. This is a monumental achievement for deep-level mining in South Africa and affirms our deep commitment to improving safety. Furthermore, our gold production remains steady year on year. We produced 1.47 million ounces, which was towards the upper end of our guidance, despite the closure of Bambanani mine at the end of the 2022 financial year. Our underground recovered grades exceeded the upper end of our guidance, improving by 8% to 5.8 grams per ton. Our costs remained under control, with all-in sustaining costs below guidance at around 890,000 rand a kilogram of gold. This was an increase of only 6% and well below our planned annual increase of 89%. So I'm very pleased with this achievement, especially in the current high inflationary environment. We deployed about 2 million in major capital towards our high margin growth projects. And on the back of the good operational performance, we generated 6 billion rand in operating free cash flow, an increase of more than 100%. This enabled us to maintain our strong, flexible balance sheet with net debt to EBITDA at 0.2 times. Although we are now in a period of high capital expenditure, it remains our goal to return capital to our shareholders. This is also in line with our dividend policy and alongside our overall growth strategy. We have therefore declared a final dividend of 75 South African cents or 4 US cents as a result of the strong group performance in the 2023 financial year. Group revenue increased by 16% to 49 billion from 42 billion on the back of higher underground recovered grades and higher average gold price received. Headline earnings per share increased by an astounding 60% to 800 South African cents. Net profit also increased significantly to 5 billion rand. Although net debt increased to almost 3 billion post the Eva Copper acquisition, earnings EBITDA for the financial year also increased by 55% to 12 billion. We were able to repay approximately 2 billion rand in debt on the back of the strong operational free cash flow of 6 billion rand. And therefore, net debt to EBITDA was reduced back to 0.2 times after reaching 0.6 times post the Eva Copper transaction. There was therefore minimal change to our net debt to EBITDA year on year as we maintained balance sheet strength. As I said earlier, costs were very well managed in a high inflationary environment. With planning foresight, our cost increases are predictable and controlled. Total cash operating costs increased by only 5% to 736,000 rand a kilogram. Labour and electricity form the largest component of our cost base. Labour increased by 6%, or roughly 20,000 rand a kilogram, mainly due to salary increases. Electricity costs increased by 10%, 13,000 rand a kilogram, due to the annual tariff increases from Eskom. Electricity cost increases were offset by our effective energy efficiency programs in Harmony. Consumables increased by 23%, or 40,000 rand a kilogram year on year, mainly due to the increased finite prices and diesel usage at Edenvale. Our net debt to EBITDA has trended downwards since 2018. Despite our various acquisitions, we have kept it comfortably below 1x. Our balance sheet remains robust and flexible, with over 7 billion rand in available headroom. This places Harmony in a very strong position to fund future projects, including Eva Copper, and to absorb any adverse trends in the gold price. Harmony has always been a highly leveraged play on the rand per kilogram gold price. You will note that for every 100,000 rand a kilogram increase in the price of gold, Harmony would have generated between 3 to 4 billion in additional operating free cash flow for the 2023 financial year. Currently, the gold price is over 1.150 million rand per kilogram, providing us with significant tailwind and strong operational free cash flows. It's because of this volatility that we have an effective hedging strategy in place. The gold hedge book is currently full to the 20% limit at an average hedge cover of 1.1 million rand a kilogram for the 2024 financial year, and an average of around 1.3 million rand per kilogram for the 2025 financial year. Please see our hedge tables in the annexures for further details on our hedging. With the capital allocation, our capital allocation framework has created a strong growth pipeline, whilst allowing us to maintain a healthy balance sheet. As I mentioned earlier, we announced the final dividend of 75 South African cents, or around 4 US cents per share. This is a final dividend yield of about 1%. The payment of this dividend demonstrates confidence in our plans and our ability to pay a dividend alongside our growth aspirations. This financial year marks 7 years since we embarked upon our safety transformation journey. We have made tremendous progress, and risk management is now embedded through Harmony. Harmony has adopted a proactive approach to safety, and I firmly believe we have the correct strategy in place to ultimately achieve zero loss of life in our operations. As I mentioned, our group lost time injury frequency rate is below 6 for 2 consecutive years now. Despite this improvement, we tragically lost 6 of our colleagues during the financial year. Harmony and our tripartite partners are continuously engaging to learn from these tragedies, and to ensure these incidents do not happen again. Each employee is part of the Harmony family, and we deeply mourn each and every life lost. Taking care of the Harmony family requires an holistic approach to safety and health. The prevention of work-related illness and mental well-being is of critical importance as we aim to go beyond zero harm. Our decarbonisation strategy has also gained significant momentum, and phase 1 of our renewable energy program is now complete. This program will deliver in total over 360 megawatts of renewables and alternative energy sources by financial year 2026. Phase 1 is now generating 30 megawatts of solar energy, delivering green electrons to our Free State operations. This represents approximately 20% of our peak Free State operations demand and around 6% of our peak daytime demand across our South African operations. Construction of phase 2 of this program will commence in this financial year. This will add a further 137 megawatt in renewable energy generation capacity. Once complete, phase 1 and 2 combined will generate a combined 167 megawatts and will save an estimated 425 million rand per annum in electricity costs. This helps us achieve our goal of carbon net zero by 2045 and reduces pressure on the South African electricity grid. Mining with purpose is what we are all about. True sustainability is embedded in all our decisions, and in Harmony, we believe in actions over words. This is evident in our respect for human rights, our people, and our focus on cultivating an inclusive, safety-focused culture. Our corporate culture encourages leadership excellence and strong corporate governance. We have a diverse and highly skilled senior management team with over 320 years of combined experience. To note that 40% of our senior team is female, something we continue to celebrate in Harmony. On board level, close to 70% of our board represents historically disadvantaged South Africans, well in excess of the legislative targets. And as a result, we continue to receive positive external recognition for our efforts in sustainability. Our decision-making is informed by our sustainable development framework. We balance all aspects of E, S, and G. We support further the circular economy through effective waste management through waste rock and tailings retreatment operations. We donate waste rock dumps to communities for aggregate production. We promote good water stewardship, prioritizing the recycling and efficient use of this scarce resource. And we contribute to the resilience and prosperity of our host communities through benefit sharing. This makes Harmony the partner of choice. In conclusion, the investment in our people, quality ounces, and operational excellence continues to yield results. Over the past few years, we have shown resilience and demonstrated our ability to deliver to plan, regardless of the challenges we might face. We have created the necessary flexibility to maintain the strong momentum we have built up at our mines. Our cost base is stable and predictable, and we have implemented good cost controls, ensuring our cost increases are in line with our plans. In short, we have improved our safety performance and engineered a high quality and diversified portfolio. We have delivered operational consistency and strong free cash flows. We have achieved in this financial year what we have achieved in this financial year demonstrates we are succeeding in our goal. In closing, Harmony is a specialist gold producer with a growing international copper footprint. Embedded sustainability practice, combined with quality ounces and long reserve life, enable us to continue delivering long-term value for all our stakeholders. Our mining teams have strong technical skills and exploration capabilities to take our projects up the value curve. Geared exposure to the rand per kilogram gold price provides us with strong tailwinds, but we focus on what we are able to control. With a flexible and robust balance sheet, we are well positioned to deliver on our operational plans. Production guidance for the group for financial year 2024 is between 1.38 and 1.48 million ounces at an all-in sustaining cost of less than 975,000 rand a kilogram. Our underground recovered grade is guided between 5.6 and 5.75 grams per ton. I am incredibly proud of what our team have achieved in the past financial year, and I am confident that we will achieve new heights in the year ahead. Thank you for supporting the Harmony story. I will now answer any questions posted on the digital platform. Thank you.
Thanks very much, Beyers. It's a good story indeed, and you can be congratulated on those results. And yes, as we have said before, we'll now go into the Q&A session, which is, of course, facilitated by the finance person, Mark Tobin. And as a reminder, just to type in your questions to the Q&A box at the bottom of your screen. And thanks very much as we hand over there.
Thank you, Deborah. Thank you, Beyers, for your time today. Thank you to everyone attending this event and to our partners A2X for making it possible. I see someone's raised a hand there to ask a question. So to ask a question on this platform, you just need to send it to us in the chat. Just please write it to either myself or to Mark Tobin, and we can then pass that question along. That's the way the forum works. So I think moving straight into it, load shedding is super topical. My power goes off just now. It only came back a short while ago. I think we're all dealing with that right now. And I noticed that solar slide, we've kind of moved from a world where solar was very much in the ESG section of the report. Then I think it started to become a financially sensible thing to do. And now it's basically a game of survival. And with a 10% increase in electricity costs, the case for solar just becomes stronger and stronger. So my first question is actually just around to what extent you think you can get there in terms of being off grid for a mine seems very extreme, but is that possible long term? What do load curtailment agreements with Eskom typically look like? I think, Beyers, just any information you can give us around that.
Thank you very much for the question. Yeah, underground mines are energy intensive, so getting mines off grid power, particularly deeper underground mines, is a real challenge. But if I could start maybe on load curtailment. So industry is on load curtailment, not load shedding, the industrials or the mining industry, which means that we get forewarning to reduce our load. And it's typically, depending on the stage of load curtailment, 10% or 20%. And fortunately, if you look at Harmony's operations, many of our operations have been designed at a nameplate capacity which is larger than the current levels at which we operate. So that gives us infrastructure flexibility to shift load into areas which is not subject to load curtailment. So what I mean by saying that is, we've got more pumps, for example, installed in a mine that we need to pump the water. So, in an area of load curtailment, we could, suspend pumping for a while and pick up the pumping at a slightly faster rate outside the load curtailment window. And similarly, we could juggle things like ventilation, hoisting, and in some cases milling in our processing units too. So Harmony in that sense, is not the typical, open cast mine, if you will, that's got all its processes in series basically. And when the crusher stands, the mill stands. We've got more parallel and we've got infrastructure capacity. So we've been able to navigate load curtailment like that in Harmony. So, we can't really ascribe major production losses to load curtailment in Harmony. And it is because, of the way that we manage it. So not only do we shift load, we've also invested from an energy intensity perspective into energy efficiency programs for some years now, where we've converted our equipment into, less energy-intensive equipment. We, amongst others, control guide vanes of our surface fans, in areas of expensive power or, reduced power in order to drop consumption. And then, of course, the renewable solar power, phase 1, 2, and 3, and 4, are those big projects. And we've, quite excited of having delivered phase 1, the 30 megawatts, and we'll be working on the 137 megawatts in this financial year. So clearly mines want stable power, but Harmony has been fortunate in the sense that we could use infrastructure flexibility to manage load curtailment.
Beyers, just on the kind of expansion into the copper side, can you maybe just talk about why copper as opposed to, some of the topical EV minerals or kind of minerals of the future? I'm thinking like lithium, cobalt, nickel, for example. Obviously copper is a big part of the, the kind of renewable and kind of future metal story. But, when you guys are looking to shift away from, having such a reliance on the gold story, how did you land on copper and maybe not one of these other metals?
Thank you for the question, Mark. Yes, copper is obviously exciting to us, but we're a gold mining specialist. And what you find is that copper and gold often occur in combination in many mineral deposits around the world. And I think testimony to that was Wafi-Golpu. When we started exploration there many years ago, it was actually exploration for a gold mine. And it ended up, in identifying a copper gold porphyry deposit, which is basically the combination of copper and gold. So So in a way, you could say that we've stumbled across the copper initially by chance, if you will. But copper and gold sort of exist together, and I mean we do have vast experience in gold mining, obviously, and there's a lot of IP around separating copper and gold, and we think copper and gold gives a good combination, of metals that we think will be important into the future. Obviously, the copper coming in gives us a bit of a counter-cyclical protection. When you've got they typically behave differently, gold and copper. So, at this stage, we're comfortable with gold and copper in the portfolio, and that's where our focus really is, Mark.
I'm going to ask a question about costs, and Bayes, forgive that this is a little bit basic, but I think it actually helps people just understand more about the sector, because I think a lot of people read mining results and they kind of don't really understand all the terminology that gets used. And one of the bits of terminology that always comes through is cash operating costs versus total costs versus all-in sustaining costs. And I don't want to obviously dedicate a half-an-hour lecture to that, but I think it might just help investors to just understand the basic differences, sort of as you go top to bottom, and what gets built up there.
Thank you for the question. There's a lot of good information posted on the World Gold Council's website as to these globally adopted definitions. So, for the participants on the call today that do want to read up a bit more on it, you could visit the World Gold Council website at www.gold.org, where the definitions are set out. But essentially, if you talk about total cash costs, it's a metric which includes all the costs incurred at the mine site and on-site general administrative costs incurred in producing the gold-bearing product. So the total cash cost is really the on-mine costs with on-mine overheads. When one gets to all-in sustaining costs, there's a few things added to that. So it starts off with total cash costs. And this is really the full costs of keeping that business going. So in general, the largest components of all-in sustaining costs, aside from the components of the total cash costs, as I mentioned earlier, are corporate overheads and also sustaining capital costs. I mean, there's quite a cost associated with developing mine tunnels to keep the mine in production, and at an all-in sustaining costs level, you would have those costs included. When it gets to all-in costs would include further below the line items, including also your major capital or your project capital expenditure. So yes, cash cost is really the on-mine costs. All-in sustaining costs include your centralized overhead costs or corporate overhead costs, as well as your sustaining capital costs, and then all-in costs include your major projects. I hope that assists in understanding those terms, but there's quite a good note on the World Gold Council website for reference.
Yeah, thank you very much. Over to you, Mark.
Yeah, just another one for me when we kind of going back to the copper story, but I mean, you've got kind of two major projects happening now in Australia, PNG, which are at various stages, quite early for the Australian one. But if we look out, 3-5 years from now, should investors be thinking there's going to be more new projects coming into the Harmony mix, or are you really focused on taking those projects through to full production, as people would know kind of Harmony in the gold space today?
Thank you for the question, Mark. And yeah, you're quite right. We've got a handful to deal with at the moment. We've got these exciting projects, and in a way, we say internally we essentially spoiled for choice, when it comes to projects, which we believe is a good thing, because projects now compete for capital, and I mean it does place capital discipline, and only capital to the most deserving projects is an outcome of that. But value accretive acquisitions is part of our strategy, Mark, and when value accretive acquisitions do present themselves, Harmony would certainly look at those. In that realm, we would prefer an operating asset, either in copper or in gold. So we're always on the lookout for value accretive acquisitions on top of what we have.
Got a question here in my DMs. When can we expect the investment cycle to peak if we include the upcoming projects like Eva or EVA and Golpu?
I'm just going to lean on Jared to help here. So Eva Copper is fairly short-term in nature. Your capital build is probably over a 2 to 3 year window, whereas Wafi-Golpu is a larger capital build, and it's over a slightly longer time frame, given the size of the project. So what I can say on that is that our capital projects at the moment are quite carefully planned from a dovetailing perspective in order to make sure that the capital calls on these projects are spread out and affordable. And I think on our results presentation, which is posted on our website, we've actually got a slide for the participants on the call to have a look at as to how we typically, from an illustrative perspective, think these projects would stack up in time. So as far as the capital peak goes, I'm just checking if we've got an answer for you on that. If we don't, we'll just get back to you. But again, I think it was included in the company presentation. So there's a peak forecasted in financial year 24, but we do know that this excludes some of our renewable capital, Eva Copper and Wafi-Golpu. So maybe you can have a look at the slide on the website to get a better sense of the profile of the capex that lie ahead.
Bears, I've got one here, and I think it touches on my kind of last question. So maybe we'll just continue on this theme. Somebody is talking about uranium as a possibility. With the price having, they say, tripled from $18 to 56 over the last 5 years. I mean, is there anything you would kind of definitely rule out? Okay, we're not going to look at cobalt, for example, or we're not going to look at uranium. We'd rather. When you talk about, looking at an acquisition of an operating mine, that would be in kind of copper or gold, or, would an operating uranium mine or operating lithium mine be, something that would, tickle your fancy, if I can say it like that?
Yeah, thank you, Mark. No, we're not, necessarily too keen on those sort of metals and minerals. We prefer copper and gold. If you look at the Harmony portfolio, we've got some silver and uranium, but they're largely byproducts of our gold mining. They're not main economic, metals we after. So as far as uranium goes, it's indeed an interesting thing at the moment. From being not so green as an energy source to sort of many different views on it now. In that space, we've got the NAFCO facility, which is the uranium facility in South Africa. There's only one licensed facility for uranium in South Africa, and Harmony is that. So any sort of other player on uranium in Harmony, we believe that in South Africa rather, we believe that Harmony would be some exposure to that routine. To NAFCO. Our uranium we produce is basically produced at our Mo Kutsong mine, but as I said, it's more a byproduct at this stage. And at these levels of prices, our uranium is watching its own face, and it's not necessarily big enough to be a big contributor at this stage. But we are watching the developments from a uranium perspective closely, and we will continue to follow the uranium story.
Bez, I've got another one in my DMs here. I think it's quite tricky, so I'm going to, there's no point in putting you on a spot. I don't believe in a particular exchange rate, but I'm going to ask a slightly broader question to help people understand, and that is, obviously in a relatively simplistic producer, the gold price changes in dollars. Anyone can go and just pull the rand dollar price. You can quickly see what the rand price is to produce your gold. You compare it to your cost, and if you're making a profit or not. Now, Harmony is more complicated than that. I guess high level, how should investors think about a move in the rand dollar exchange rate and what that means for all your economics? So in other words, not just what you're earning on the gold price, but your cost base, to what extent are you exposed to, I suppose, currency volatility? I know it's quite a difficult question, but any commentary around that to maybe just help investors understand? Because I've got a couple of questions about, at this exchange rate, what would you be doing with costs? What would your break even be, et cetera, et cetera. So maybe just high level.
Yeah, sure. I guess depends on which side of the table you sit and what hat you're wearing. I mean, if you're wearing your South African citizen hat, you want a strong rand, for obvious reasons. If you wear a gold mining hat in the near term, a weak rand supports you because of the the dollar price of gold, but it also somehow comes back at you in costs later on with inflationary pressures. So we don't get fixated about the gold price. We can't, we don't have a crystal ball like none of you have. So we believe in controlling what we can control, and that is the underlying health of the business. So safety excellence, production excellence, cost discipline, capital allocation with discipline, those sort of things that are in the control of management. And hence we've done significant work since 2016 to reposition or re-engineer the Harmony portfolio towards higher margin, better quality assets. Now, that obviously makes more money, but it also gives you that protection, when you do have, the down cycle coming through. So although, those are the dynamics when it comes to the rand-dollar exchange rate, we believe, you can confuse yourself, if you will, in getting too much into that. So we focus on, the underlying health of the business, so that, when you get adverse exchange rates or adverse, gold prices, that you can weather those storms. We have included, a little bit of a hedging strategy, both on gold price and exchange rate, and it's not a speculative strategy by any means. It's really to protect the downside. So, should one have a dip in the gold price or a significant strengthening in the rand, just gives you a little bit of a longer period, to right size the business and, to restructure accordingly. So, I hope that gives our participants on the call today a little bit of color on sort of how we argue around the gold price. It is there, it's always there, fundamental part of the business, but out of our control. And hence we try and focus our managers and people in the company on what is within our control.
Bears, I've got kind of two questions that are on a similar theme in my DMs, and it's around kind of going back to CapEx a bit, but in terms of financing CapEx over the next couple of years, we see a lot in the mining space where a mine might be a JV between two guys. You guys are working, I think, correct me if I'm wrong, but Newcrest, Newmont and the Eva project, if I remember correctly, or maybe it's the PNG one. I might be getting confused here. But so just maybe talk around that. Have do sell a portion of your interest to the Newmont guys, or rework the shareholding where they're going to front up more of the CapEx for a bit more equity, and it's it's coming off their balance sheet rather than yours. So just maybe around the financing of that CapEx, and what are some of the levers that can be pulled to do that.
Yeah, thank you, Mark. Interesting questions. So in the near term, I think in the presentation we touched on our net debt to EBITDA ratios, we touched on our headroom, we touched on our balance sheet, which is quite healthy at the moment. And from that perspective, we think in the near term, we can quite easily, we're comfortable to deal with our capital calls in the near term. So, we're not too worried about that. Wafi-Golpu is the one that we are in a 50-50 JV with Newcrest, and we know that Newcrest and Newmont are the Newmont shareholders are about to vote on that in November, I think it is. That is a tier one copper gold asset globally, and Harmony would want to participate in that as much as we can. I mean, that's not something that you'd want to give up to anybody. I mean, it's a fantastic asset, and it is big. At this point in time, it's a 50-50 JV, as I said, between us and Newcrest, and the Papua New Guinean government have the option to take up to 30%. So that leaves the JV partners with the delta of the rest. So yeah, we wouldn't, we would like to participate in that mine, as much as we can, because it's really going to be a phenomenal mine that that has to be built.
Yeah, it's quite interesting to see the DMs. There's some comments that along that vein are kind of like, would you sell parts of the portfolio to provide capital for projects versus issuing equity? And then another comment that someone doesn't want to be left out. Don't go and raise capital to finance that project without retail investors participating. So it's not every day you'll see that anymore in the local market. So that's nice to see that there's some keenness to kind of follow through from your shareholder base. From the same person, we've got a question around Hidden Valley. I just want to go back up and grab that one. And it just talks to the stripping cost. And maybe that's a very good opportunity to actually spend 1 minute on what that is. And it works out to about $460 an ounce, assuming that underlying data is right. Is that included in all-in sustaining cost for that mine?
Thank you for the question. So we typically deal with our stripping cost as capitalized stripping cost. So it is, it is below the line, and it's worked off as we mine the ounces that we've stripped. And I mean, the principle around it is, typical open cast mine, when you get to the bottom of the pit and you want to extend the life of mine, you have to strip the waste walls at the top to get to the bottom. And that's obviously associated with lots of cost initially, and the benefit is only accrued later. So that's really, the way we deal with the deferred stripping, and it's typical of open cast mines. When you strip, you incur a lot of costs, called deferred stripping, and it's called deferred because it's capitalized and then worked off. So it is a sort of reiterative process as you go on a typical open cast mine through the various cutbacks. And I think at the moment, we've announced a few years back, we've announced stage 8 cutback at Hidden Valley. So what you do see in the costs was, some of the stripping costs up front, in order to progress stage 8. And we also have what we call HV, or Hidden Valley X extension, and HVXX, which are projects we are working on, to even extend the life of Hidden Valley further. And just interestingly, it's not so much a function of finding the gold. The ore bodies are there. The country and the topography is really, tailings deposition constraints. It's a mountainous area. You haven't got a lot of flats, so building tailings dams is really the constraint in terms of extending that life of mine. And our teams are working on, finding solutions for, tailings deposition going forward for HVX and HVXX.
And there's just one, when we're talking about all-in sustaining costs again, I think the all-in sustaining cost for FY22, I think, was 835,000 per kilo, and the guidance for next year is 975,000 per kilo. It's quite a decent change year over year if we go 835 to 975. Is that what you're saying, like kind of the exchange rate coming to bite you on the back end, when you're like buying kit from Caterpillar or any of these other guys that are, pricing it in dollars. So, when you come up to that next renewal cycle of parts or kit or whatever, now you're, instead of buying it at 16 Rand to the dollar, as you were maybe 2 years ago, now you're buying it at like 19 Rand to the dollar. And that's like kind of what's kind of feeding into that, like, actual stuff that gets used on the mine.
Yeah, thanks, Mark. That's where the, wheat grant sometimes gets you in inflation, but our cost base is a little bit different. Specifically, if you look at the majority of our costs in South Africa are denominated by two things, really, and it's labor and electricity. I mean, that accounts for 60% of our cost. So if you look at labor, we are we're approaching the 3rd year of our 3-year wage agreement with our organized labor colleagues. So, we know what our labor is going to be for next year, and that's priced into that number. And similarly, the NERSA-approved ESCOM increases, is also built into the plan. So, those increases aren't as high as you think, Mark. I mean, there's actually a year-on-year on the guidance. It's 8%. And if you look at numbers that came out recently from industry peers, 8%, 6% is a fairly good number compared to what we have seen. Where obviously, the basket of goods for companies that's got different portfolios are slightly different. Some companies are more driven by diesel costs or mining equipment or mining kit costs. So for us, 60% of the costs is labor and electricity, and we know what those increases are. So we've got a fair amount of confidence that our costs, as I said in the presentation, is predictable, and that we've got control over our costs. What we have seen in the last year, though, was fairly excessive increases in what we call reagents. Now, that's typically some of the chemicals we use when we extract the gold, like cyanide, hydrochloric acid, and things like that, up to about 23%, I think, in the numbers we reported. We're seeing a bit of a softening of inflation at the moment. But yeah, so that gives us confidence that the 8% in the guidance for next year is a number that we fairly confident on, and we think in the sort of high-ish inflationary environment, we think it's quite a good performance.
Bez, there's just an add-on to that last question. Sorry, Mark.
I was just going to jump in and just say the renegotiation of that agreement. Is that going to kick off kind of early next year? Should we expect to see an announcement about that, sometime in the next financial year, kind of all going according to plan, or when are negotiations, scheduled to start?
Just taking Mark, talk about wages.
Yeah. If you're going to go another 3-year agreement,
Yeah, it'll start next year, our discussions. We already, we believe in transparency and openness and continued communication. We're already, sort of talking to our stakeholders around that and, sort of starting the discussion. But yes, it will formally start next year. And, we'll see, whether it would be a multi-year thing or whatever it will be. But perhaps I should say at this point that this current 3-year cycle, we've signed with all our unions in one day when we signed it. And for those who don't follow mining, that's often difficult to achieve because, obviously different unions and different stakeholders have different internal processes. But, we've had overwhelming support, from our stakeholders when we signed this agreement, and we were blessed in the sense that we could, deliver it without industrial action and, no interruption to operations. And, we've had the support of our unions, and, suppose part of our DNA would be to keep our, stakeholders close. And, when it does come to, wages, that we continue on that front of, working with one another and, mutually respecting one another and trying to find, sustainable, wage agreements going forward. So, it's coming up next year, and but as Harmony always have, we'll work with our stakeholders to conclude that as soon as we can.
Bez, I just want to finish off that last question because it seems there wasn't 100% clarity on the stripping cost. So is that stripping cost that gets capitalized, does that mean it's included in all-in sustaining cost or not? It should be a quick yes, no, and then I can ask you another one.
No, it's not included.
Not included. There we go. Okay, so that's clarity on that. And then there's a question here about long-term expectations for your free cash flow margins for the optimized group of assets after your recapitalization efforts, as sort of verbatim. I guess just long-term expectation on free cash flow margins. What do the targets look like for Harmony? And sorry, linked to that, your dividend policy, I just want to confirm, it's based on free cash flow, not on HEPS. So maybe worth commenting on that as well.
All right, perhaps on the dividend one first, the easy one. Based on net cash, 20%, so not HEPS, headline earnings per share, it's net cash. On long-term margins on long-term capital, I'm not necessarily going to guide long-term into the future. But, if you followed our story in our presentation, well, in gold mining, grade is king. When you do have grade on your side, that's where you want to be. And if you look at our capital investment criteria and some of the capital decisions we've made, we're investing our money into our high-grade mines. And, from a margin perspective, that is how we want to drive the costs down, and obviously the inverse of that is improved margins. So, we're quite excited about that. Our Mponeng asset this year have produced 2.2 billion rand in cash, and that's the sort of asset which you want to nurture and grow and continue to invest in, because that is what differentiates the portfolio from a margin perspective. So you'll follow in the slide, I think it was on slide, if I could quickly just page back, you'll see we talk about 4 quadrants. And that's quite important for us because, as on slide 6 there, the 4 quadrants are 4 distinctly different parts of, the Harmony story. And we talk about, almost 4 equity stories in one. And, it is about expanding the margin by investing in, the high grade underground, as well as the international copper and gold and the SA surface sources, because that's where the margins are. If you follow our capital investment program, that's where we're going.
Ghost, I'm checking here, but I think I'm all good on my questions. If you've got 1 or 2 left in your DMs.
Yeah, I've got one. It wasn't a DM one, it was a ghost one. It's just talking about tailings and I guess how tailings offer different economics to the rest of the business. And I just wanted to understand from you, Baz, how do you think about risk weighting the tailings business opportunities versus actually getting the stuff out of the ground for the first time? Again, I like to ask these questions for people who might be newer to the industry and learning about mining, because it is quite a specialist thing.
Yeah, good question. Obviously, tailings mining or recycling, as it's often referred to, is as we included in the presentation, part of the circular economy, cleaning up of mine waste, and it's got good ESG credentials as a result of that, and the fact that it's safe, and it is it's got high margins. So we're keen on that. I mean, at this point in time, we're building out the Karierand tailings dam extension, and that is to put further life into our mine waste solutions, which is really our big tailings mining operation. We, in fact, are the biggest globally, in terms of volumes on our tailings business. So, tailings is very important to us, and we believe we'll add even more surface gold, to our portfolio. But we also feel, although the surface is high margin, they are relatively not small, but I mean they're smallish compared to underground mines. So we believe a good combination of high quality underground mine with robust margins and lower all-in sustaining costs with surface production is a good fit for us. So yeah, very excited and very keen about adding further surface gold to our portfolio.
Maybe that leads very well
from a risk reduction perspective. Sorry. I suppose obviously always, yeah.
And maybe that leads well into what I think will be the last question today. What a banner to finish. You don't know how you're going to do this in a minute or 2, but we can try. Any interesting acquisition targets left in South Africa to consolidate gold production? A nice juicy one with a strong example there of Sibanye, which clearly you can't comment on, but I suppose high level. Are you guys looking at acquisitions in SA, or are you casting your gaze far away where people have electricity?
Yeah, so we're not scared of South Africa as a jurisdiction. I think it's evident in our capital allocation program. We're spending quite a lot of capital in South Africa. I guess it's a case of knowing what you deal with and operating well here. But I think we're out of time. But I think we are out in saying that we will only consider acquisitions that would improve the quality of our portfolio. In other words, it would reduce our all-in sustaining cost and improve our margin. And from a gold space perspective in South Africa, we don't think there's much runway left to do that. So I guess that's how we view what's left in South Africa from a gold perspective.
Unless Neil gives it to you for a really knockdown price, then it would improve it.
Cheap is not always value.
Yeah, I think we're going to have to leave it there, guys. Bears, thank you very much for joining us and giving us the Harmony 101 and a bit of mining 101 as well for some of the retail investors. Yeah, it was great to hear the story, and hopefully you can join us again at some stage in the future. I just want to hand back to Deborah now just to wrap up a few little loose ends for us. Deborah?
Thanks, everybody. I hope you can hear me and we have no more gremlins in the system. It's been challenging. I think load shedding has stopped a lot of the free flow conversations, but I just want to extend our thanks generally to Baz and his team for joining Unlock the Stock, which, as you know, is designed for investors to have direct contact with management. I'm not going to spend much more time, just to pop out a quick reminder that we are having the next session on the 14th September, which is in a week's time, with the CANS group. And we'll be sending out invitations for those soon, so please keep a lookout for those. And if you missed any of today's sessions or want to catch up with our previous sessions, please do, we encourage you to subscribe to the Unlock the Stock YouTube channel, where you can get all the content, and we'll be putting up this video as soon as possible. And that's really it for me. So thanks very much to everyone.